Syndication in its simplicity is a group of people combining resources to make something much larger happen. So in the case of real estate, you can go buy your own duplex or single family home, but maybe you and a friend who also does real estate, you combine resources and you may be able to go buy like a 10-unit apartment. And then maybe you get a third friend in there and then you raise capital from investors and you can go buy a 50-unit apartment.
This is Internal Rate of Return with Amanda Alexander.
In today's episode, we meet Flint Jamison. Flint spent 2 decades in the aerospace industry where he made significant contributions as an engineer and program manager. Among his many achievements, he's best known for designing the wing structure of the Boeing 787, a groundbreaking project that highlights his technical prowess. Flint's career didn't stop there. He wrapped up his aerospace journey managing a $120 million program focused on modifying aircraft for the military. But his story takes an intriguing turn from the skies to the real estate market. In 2018, after experiencing a period of burnout, Flint turned his focus to building a new financial future for his family. He started by purchasing cash-flowing real estate, beginning with a duplex, like me. His quick pivot to commercial real estate marked the beginning of his path to financial freedom. Recognizing the power of this asset class, Flint founded Vestus Capital with a mission of educating other leaders on how to grow and protect their wealth through passive investment in commercial real estate. Flint is a proud father and husband who has visited all 7 continents with his wife before they had children. I may have to ask you a little more on that too. Flint, welcome to the show.
Thank you. That was a really good intro. Like I almost want to capture that and put it on my website.
Hey, go for it. You'll have access to this and, thank you. I like to do a little bit of homework on my guests and I'm really excited to have you because we're going to get a bit technical here for our audience. But before we dive in, I like to start with a check-in question. What are you feeling grateful for at this moment?
Gosh, so much beyond just like the career life and all that. I think it's just family health. Recently, my parents are getting older, and my father just went through the hospital, and he's getting out of the hospital. He's recovering and rehab, and so all is good there. But it's just reflection on life and family and what matters most. So
Yeah, the things we take for
grateful.
granted, being able to hike or walk or, just the simplest things. And it's a reminder of the fragility of life and how we got to take care of ourselves, right?
Yeah,
So
absolutely.
thank you for sharing that. Well, as I mentioned, I want to walk through a very specific year for you, but you can bring it to more recent examples. But in 2022, you did 4 amazing things. So, one, you did your first capital raise on a syndication, 104 units in Augusta, Georgia. 2, you created a fund to fund. 3, you got into build to rent or new developments. And then 4, you left your job as an engineer to become a full-time investor. Did I get that right? That happened all
Yeah,
in 2022? Insane.
close to. I left my job. Close enough. January 23. So yeah, within a year of all that madness. Yes,
You are a fast mover. So, before we even
maybe
jump,
too fast.
well, you look like you made it out on the other end. So that's a good sign.
Yeah.
But I think it would help our listeners to describe some basics. So I will start with, I know what this is, but for the sake of our listeners, what is a syndication and what does it look like to raise capital or do asset management? Because I believe those were 2 of your roles on your very first team.
Yeah. So gosh, so much has happened. Yeah, so syndication in its simplicity is a group of people combining resources to make something much larger happen. So in the case of real estate, you can go buy your own duplex or single family home, but maybe you and a friend who also does real estate, you combine resources and you may be able to go buy like a 10-unit apartment. And then maybe you get a third friend in there and then you raise capital from investors and you can go buy a 50-unit apartment. And that's when you really get into syndications. So
That
it's scaling your efforts
well
to do bigger
said.
things.
Scaling your efforts to do bigger things and combining resources. I'm actually, when you said 50, I'm actually syndicating on 51 units specifically right now.
Oh,
And
congrats.
thank you. Okay, so another basic, just a definition. What is a fund to fund?
So it, it can be a lot of things, but in general, let's say there's a big operator out there who's putting together a large fund of maybe 5 properties. could be 5 multifamily properties, 5 self-storage properties, but they're going to do like a $50 million large fund. And their minimum investment is, say, $100,000 or $250,000. Where a fund comes in is we come in below, where I can raise capital from my retail investors and I can change the minimum. I can make it 25,000, 50,000. But when I turn around and raise that money, I essentially write a large, say, $1 million check to the big operator. And on top of that, because I'm writing a huge check, I get negotiable return structure. So I get a better return structure by writing a larger check to them. In turn, I can give maybe beneficial returns or equal returns to my investors. And it allows them not only to get into the bigger opportunities that they couldn't before, but possibly get some better returns.
That is awesome. And opening my mind or expanding my perspective here, because I'm still in the syndication field and thinking about fund to fund. And just as I raise capital, I'm realizing one of the big parts of it is just educating, hoping to eliminate fear. I'm not trying to be salesy. It's more just, let me bring you along with the things that I'm learning. And then if this makes sense for you, you can be part of it. Right. But it's a little more complicated if I were to try to wrap my head around a fund to fund. And so I'm really curious, how did you go from maybe the limited partners on your first syndication to getting them to sign on, if they were the same investors, getting them to sign on to this fund to fund that you created?
Yeah. So I guess the fund to fund, it does add a layer of confusion, but really at the investor level, to them, it doesn't matter. There's a layer of transparency there that is really what does matter is, oh, you want a piece of this 5 property portfolio for $25,000 minimum or $50,000 minimum, and here's your returns. If you like those, it doesn't matter whether it's a fund to fund going into a big primary fund or not, because we're projecting certain returns. If you like it, that's what they jump into. And if they like the primary operator as well. So I think it's behind the scenes, the SEC attorneys and the documents and all of that. Yes, there's some complexities, but in the end, to the investor, I don't think it needs to be overly complex.
I imagine that you simplify as like the liaison in a way. You're simplifying things because there are probably a bunch of numbers to crunch to understand the primary fund and the different endeavors they're taking on in their business plan. But then you somehow take all of that and then simplify it into maybe straightforward returns for your investors. Is that how that
Yeah,
works?
and so the primary fund typically works with us fund to fund managers because we are going to get a negotiable return out of it, a beneficial return, I should say. But then they also work with us because we do have to calculate, because there are splits. It does cost me money to run my fund. I will have to do accounting. I will have to create the K1s. That doesn't come from the primary fund. So there is some level of expenses. So that's why I have to get some preferred return, higher level benefits, so I can scrape some off the top, cover my expenses, and give my investors a good return as well. So yeah, behind the scenes, there's a little bit more work.
And one way that you described it really well, and just for my listeners so that they understand. So if like, why would we go to the middleman? One benefit is they would know you. So the relationship and the trust
Yep.
is there. But by design, these primary funds will make the returns less on, say, a $50,000 buy-in, if that's even on the table, or there is no such thing as a lower buy-in. And so the only way to get into that primary fund would be either through, the fund to fund,
Yep.
or recognizing that in the fund to fund, you're actually going to get better returns than if you were to go direct. If I'm
Yeah, possibly. And I think the big part of that though is also the trust. Like my investors, friends, family, investors come to me knowing that I've spent all of this time networking and understanding how to underwrite. Like they're putting their trust in me that I've done all the work for them. The other part that they like about coming to me is, since I'm not the primary operator, I I can bring a diversified portfolio to people. So if I was a primary operator in, say, Dallas Fort Worth doing Class B value adds, and I'm just like the expert in the area, and that's what I'm doing is rinse and repeat, my investors are only doing Dallas-Fort Worth Class B value-added multifamilies, when in general, they might want to eventually diversify, get out of Dallas, to Houston, do Phoenix, do something else, maybe do self-storage. So that's where it really benefited me to leap outside of being a primary operator to doing these fund of funds or co-sponsor deals, because I have assets, I and the investors have assets all over the country and different types of asset classes. So it helps if they just know me and I go seek out the good stuff, because I am location and operator agnostic as long as they meet the thresholds of a high bar of quality assets and
That's
operations.
a perfect segue to my next question, which is, it's one thing to vet, a syndication on one property and then vet that team and the operators, but, part of what they're buying into is their trust that you've done the vetting. So what does that look like? I imagine it's pretty sophisticated, but I'm also curious, just, you're an engineer, and, when you're
Yeah.
sharing even a deal with most walks of life, an engineer actually wants to look at the underwriting and, peek under the hood and look around. So what does that look like for you on a
Yeah.
business plan that's this big?
There's a lot. I mean, I have checklists upwards of 100 things to check off. And the initial thing I go in for is, one, it's really the operator. How well do I know the operator? If I don't know the operator that well, how good is their track record? And I can sort that out fairly quickly. Like, how many have they done? How long have they been in business? Have they got any capital calls? Those are some of the initial triggers. And then after that, you start diving much deeper. The underwriting and the returns on the asset, absolutely out of the gate, you're like, 12% returns, that's probably not worth it. We're seek something much higher. Fixed debt, bridge debt, all of that stuff. You got to take all that into account, even down to just background checks on the operators themselves.
Like
Hard
actual
lesson
background?
learned. Yeah, like
Oh, no.
actual. That's a normal thing. I mean, if someone asks for a background check, you do it. You
Do
give
you
it to
use like a
them.
website that like you
Yeah,
run it
there's third
yourself?
parties. Yeah,
Okay. That makes sense. I mean, we do
or
background
even
checks.
investors. I mean, they can run background checks themselves on me.
Do you direct them to a specific website or anything, or do you email them your background check? Or how does that
Um,
look?
yeah, I think a lot of the operators, they'll just send me their background check if they've had them run recently. Like if it's 3 years old, you get a new one. But yeah, it's actually been a while. I can't think of one off the top of my head. I'd have to go pull it out of my system. A lot of the operators I've worked with recently, I've worked with for a very long time. So some of that is like, it's a quick turn when it's, oh, these guys got another property. They're inviting me back onto it to bring in more capital. So some of that stuff it gets easier over time
Right. As the
working with the same
relationships
people.
get built. But when you say how to check the operator's credibility, you mentioned a few things: the track record, how many have they done, how long, and
Along, yeah.
yeah, and have they ever done a capital call? Do you find that out through calling references that have been on other deals, or what is the way of vetting that?
So yeah, there's a couple ways to do this. One, you ask them straight up and how they respond. I mean, if hopefully they're honest and they say, yeah, we had a capital call, or some of the more recent ones are more like, have you withheld distributions? And likely if they acquired a property in 21 or 22, there's a high chance that they're withholding distributions just because the interest rates spiked. And so then you dig a little deeper, and it is what it is. I mean, I have distributions withheld too. So is the property still stable? Is the investors' money still safe? I get they might not be getting their quarterly distributions, but you kind of dig a little bit deeper. Why are you in this situation? And if they're fully open and honest and they tell you why, if they have lessons learned, because when you get into real estate, things happen, period. I only know one person that says, yeah, things are swimmingly great. But in real estate, that's where you kind of dig. You want to know what are some of the biggest challenges they faced, how they got through them, how are their problem solving skills. And then to your point, I think it's great to get referrals, and get referrals from an investor who's in their worst deal.
Mm,
But
nice.
sometimes the good operators, when they have a bad deal or when things aren't going as planned, they're open and transparent and communicate early and often. Hey, here's our problems, because then they're at least they're trying their hardest
Right. And communicating all
and
along the way.
communicating. Yeah.
Yeah. And just a quick walk back for my listeners. So, a capital call, or actually even before that. So, if you buy into a syndication, you are looking at projected returns. So, that's ultimately a forecast or just, a model of
Yep.
how we think the money will come back to you. And
Yep.
so, these distributions that may be projected to come to you on a quarterly basis, let's say that things get more complicated with the project and we end up needing to spend more, or something else happens with the finances where you're just not going to get the distributions. That is a reality that can happen. And then, a capital call is when we maybe underestimated the amount of money needed to move the project forward, or we overspent and then now need more capital to right the ship.
Yeah.
So
Right.
those are things I'm learning. Hopefully I don't have to experience those too hard in any of my deals, but I'm learning.
Yeah, it's always good to have good reserves in place. And it depends on the age and how much maintenance and value add deferred maintenance needs to happen. So like older properties, you definitely want more CapEx or reserves
Mhm.
than say a newer property.
I actually had
So
a question about, and this is pivoting a little bit, and I'm going to probably come back to both syndications and fund to fund, but can we quickly define build to rent? Because I want to ask you a question about contingency reserves. You mentioned that, and I was wondering how that gets modeled. So let's go to build to rent. What is that?
yeah, build to rent's a phenomenal asset class. It's really gained steam over the last few years. It is like building a single family home community with the express purpose of renting the units. So another way to look at it is like horizontal multifamily. So rather than people living in an apartment, they're living in their own single family home. Yeah, I can talk for a long time on this and all the benefits of it, but I guess to get to the point, right now the supply of homes is low and the demand is really high. With That's causing the valuation of homes being really high, and it's making it hard for people, especially first-time home buyers, to get into their first homes. So in the build to rent scenario, it's almost the best compromise for people who want to get out of apartments. Millennials are the biggest population that's in their starting families, and they need to get out of apartments and they want to buy a home, but they can't afford a home. So the best compromise is these build to rent units for building essentially entire communities of starter home size homes that they can come in and rent. They treat it like it's their own home. They don't have to do any yard maintenance. They have a community behind them. There's a lot of these will likely have pools and stuff, right? Amenities for families. So it's a great asset class that is popping up everywhere. And
That's
now
great.
investors are coming along with us.
Yeah, you got me wanting a ticket here. Horizontal multifamily. I haven't heard that, but that makes a lot of sense. So I have two follow-up questions about build to rent. One of them is about which markets do you see these in? I know that, maybe certain cities might not be, accommodating to this, but or maybe it's the suburbs of those cities. Where are you specifically doing most of these projects?
Yeah. So I think the hot market right now with one of my deals is Phoenix. We're starting a 10-year fund where this is a slight pitch here, I guess. The goal here is we're going to build to rent communities for the next 10 years. Investors getting in now will ride along this wave. And our target is to buy 3 to 4 this year. And every time we sell, we essentially double your money. But rather than say, okay, we doubled your money in 2.5 years, congratulations, here's your money back, we take that 2x money and roll it into the next property to double it again. So 4x, 8x, 16, 32. So 5 cycles get you to 32x return in 10 years. It's a big number. A lot of people are like, well, that's not real. And I'm like, it's possible. Even if we're half as good, it'll be 16x your returns in 10 years. So I mean, but yeah, there's so much demand there in the Phoenix area that we project we can build these consistently for the next 10 years because they need the supply. Other places are like Austin, Texas is booming with build to rent, same as Dallas. Colorado's, the Denver area, suburbs area is starting to pick it up. Yeah,
All right.
they're in a lot of places.
Yeah, this is awesome. What's the buy-in for that 10-year 32x
Their
return?
minimum advertised minimum is 100K.
100K.
It's a 30 so this is a $35 million fund, and yeah, at the moment of talking, we have something like 20 million in the bank and soft commits to up to 35 million. So it's got a ton of interest. We're closing out soon.
That's awesome. Congrats. And I don't mean to stereotype or generalize, but if there's anyone I trust with, what seems like unrealistic projections, it's going to be an engineer. So, you guys really get into the numbers and the assumptions, and, that's pretty incredible. So tell me a little more about, you mentioned, they don't have to mow their lawns or do that kind of upkeep. Like, what does property management look like in horizontal multifamily, AKA build to rent, single family communities?
Yeah, I would say it's very similar to property management of an apartment building. You still have lawn care and maintenance of all the units. The maintenance is different because you have a whole bunch of individual houses to deal with. So there's out of the gate, they're all brand new, so the maintenance isn't that high. But over time, you could have 150 roofs that you'll have to worry about rather than one big roof or two big roofs. And same with AC units and all that. Well, typically, I guess AC units in an apartment building, they're all individualized anyway, but it's very similar.
Okay, that makes sense. And bringing it actually back to the pivot that brought me here, which was about just having your reserves. And you mentioned like contingency reserves. How do you model that for these types of projects?
Digging into numbers off the top of my head, I don't remember. Sorry.
That's okay.
Yeah, there's going off the top of my head, so I could be wrong on this. At the moment, I think we were doing 10 to 15% on materials increase costs. And this depends. I've got a couple other built to rent properties as well in Louisiana and Alabama, but two very different business models. One of them, to answer your question more directly, the one in Phoenix, what we're doing there is we are straight up understanding what the material costs are now. We're about ready to build, and we go buy 100% or most of the materials up front. Like we prepay up front. What's the cost of lumber now? This is how much square footage we need. And we buy it now, because if there's a cost growth, we don't have to worry about that cost growth because we're paying for it now, and we're underwriting for that price now. So we're kind of hedging our bets at that point. If it pencils at the price now, then we're going to go with it. If the price goes down, okay, so we may have overpaid. But if the price goes up, we don't have to hedge our bets further on that and have that 10, 15% reserves there. I mean, you always want reserves in place, but it depends on your strategy about how much you need in reserves. So prepaying up front, you need less in reserves.
That makes sense. But it also sounds like to have some assumptions baked in that help you calculate your reserve amount, you have to have done a few of these. And I'm curious, did you have folks that created the fund to fund with you in the beginning, or this is just, it's come with experience? How did you, I guess, build off of experience in order to create the right reserves?
So some of this stuff, like when I jumped from multifamily value add, jumping into build to rent, I had to learn all that stuff. And a lot of this comes from trusting the partner that you're jumping in with and trusting the builder that they're partnered with. So that's the biggest thing, is when you're doing development, is how partnered is the actual builder in this process, and you're using their underwriting. Similarly, when you go underwrite a 1980s multifamily property, you want to talk to your property management and get their third-party input of what the projected rents could be, what the costs are going to be. Right? You're getting all these third-party inputs, because I'm not going to magically come up with those numbers. You have to go get quotes from all these third parties. Your underwriting should have mostly been driven by third-party estimates. You think insurance, your taxes, you got to call the tax attorneys if you have to, or just call the state, call the city. What's your projected taxes going to be? Similarly, insurance. So in the build to rent and the costs of building these, you have to really understand the builder and their inputs and why they're putting those assumptions in there.
Yeah, makes sense. It gets really detailed really quick.
Yeah, I can't be an expert in all things. So at some point you do have to start trusting these individuals.
Right. And you mentioned buying the materials and factoring the costs now, but if you're not ready to build just yet, where do those materials sit?
So in this scenario, Phoenix one, we're working with a builder that owns their own lumber storage yard, or lumber yard. So, and there's some details here that I'm not totally privy to, I guess, because I know you can, in certain scenarios, you can pre-buy fuel. Like if you're a shipping company, I've heard they go pre-buy fuel for the next year, and they buy, 10 million gallons of fuel at this cost. So they're hedging their bets there. And so in this scenario, we kind of do the same thing. Or you just make an agreement, hey, this is what we're going to pay for the next year on lumber. And the builder or the supplier takes on that and says, okay, we don't know what it will be, but we're gonna supply this to you. It doesn't necessarily mean you're just taking it all on and storing it.
I see. Yeah, because that could be risky. Things can get
Yeah.
stolen. And okay. So maybe even backing it up for the listeners, with build to rent, there are three phases. There's buying the land and getting the entitlements. That's one. The second is
Mhm.
cutting dirt, so putting in utilities, sidewalks, etc. And then the third is vertical, where you actually start to build the houses. Can you explain what entitlements are? I understand what it is, but
Uh,
maybe for my listeners, just so that they can understand.
there's so much behind it, and I feel like every time I get on the phone with the group and we're doing, updates and status, there's always the next thing. So when you buy land, there's a lot of the entitlements encompasses a whole lot. You got the zoning, you've got environmental inspections, you've got the engineering and permitting, safety. Um, we've gotten in challenging situations where the city decided to come back and say, hey, we need a right turn lane built in here. And that actually took off about 30 feet of our available land to build on because they're putting in a turn lane. So that all kind of comes in the entitlements of, is the city going to approve it? Are they going to make modifications to how we're doing the engineering, how all the utilities are put in there? So all of those approvals prior to permitting is what I kind of lump under entitlements.
I see. And do you have to bring on like engineers and architects at that
Yes.
stage? And I imagine it's
So
very expensive.
yeah, engineers basically lay out the entire property for you, and then they typically work with the city to get the permits in place.
I see. So we mentioned actually on the podcast that I'd listened to that phase one it can be more risky. And I'm
Mhm.
curious, like how long I mean, I guess it will be lot by lot or just, project by project, but that can take a while, it sounds like.
Yeah.
And so let's say you're an investor and you buy in at that phase. What happens to your money if the city shuts down the project?
Yeah, you can sell the land for whatever the land's worth. And at that point, you're probably going to lose some money because typically when you invest, you're also paying the engineering firms to do work. You're typically have a loan. So you're not just putting cash down on the full piece of property, you're getting 70% loan. So there's going to be premiums there that you're paying as well. And so ultimately, I think it's going to be a loss unless for some reason the land is going to get purchased for more.
I see. Good to know. And then maybe another definition that you can explain is what is yield on cost?
Oh, I should have this better queued up in my head. So a yield on cost
And I didn't mean to
are
put you on the
just,
spot. Yeah.
yeah, I should be able to answer this question better because we normally don't work on yield on cost except for build to rent. And I don't even talk about it that much. So I don't know that I'm ready
Okay.
to give you a clean. I feel like if I gave you an answer, I would be stumbling through it and it wouldn't be clear.
Yeah, it was something about like the yield on, for example, when buy the materials and then the yield from like, let's say, actually building it up, like that wood or whatever, the materials that went into the property are now worth so much more because it's now a property that can be rented, is kind of how I'm imagining it. Is like you go from like raw materials to actual like higher yield for what you paid wholesale to get those materials
Yeah,
from something.
it's It's yeah, because if you buy say the piece of land plus the cost of construction plus the materials, and all of that initial cost was say 15 million, and then you turn around and sold it for 30 million, that difference is your yield on cost versus your average annual return. You divide it by number of years, and then IRR is obviously the much more complex equation with time value of money in there. So yeah, it is definitely a different way to look at money, and or a different way to look at returns. And a lot of sophisticated investors out there will look at the lump sum of all the returns to figure out which one they really care about.
Yeah, makes sense. That was a great answer. Okay, so what have you seen in terms of trends with construction costs over the past few years? Are they stabilizing or how does that look?
It's interesting. Yeah, during the COVID era, obviously everything spiked a lot, and it's since tempered. I haven't actually looked at the numbers in the last 6 months, but when I did look, the cost of concrete and wood had gone back down to near pre-COVID levels. So the spike had resettled within a percentage or so. Fuel costs are still higher, and that does impact the industry simply because it takes a lot of energy to build. So that is an impact there. But in large part, I think they've come back down to a level that's manageable.
Makes sense. It sounds like we're stabilizing a little bit, and I hope it stays on that trend. So many details to think through as we're talking through these. I'm going to maybe go higher level and back to what it's like when you're talking to folks who are buying into a fund of fund, and how do you simplify it for them? And so I'm curious, are the LP, is it called an LP when they come on to fund of fund?
Yeah.
Okay.
Yep.
So when the LPs come onto that, what type of returns can they typically expect? I know it's going to range by project,
Yeah.
but like, how do
So
you even simplify that for them?
on a build to rent or just in general?
Let's talk build to rent then.
Yeah. So our build to rents were originally targeting doubling your money in like 2 to 3 years.
Wow.
So that was the primary metric I was working with. Your IRR is pretty high at that point. Your average annual returns are pretty good, but in general, we wanted to double their money quickly. So here's the pros and cons to build to rent is you don't have any cash flow. I mean, there's no renters up until you actually start completing these units and putting renters in them. But typically, once you start getting cash flow, as you finish your first tranche of 10 and you're building 150, you can populate them as you go. But typically, those returns are starting to go. Your rents are going now to help pay costs and ease on the cost burden. So yeah, in general, about 2x in 2 to 3 years
That's
versus your value adds is like 2x in 5 years on
right.
average.
Wow. 2x in 2 to 3 years. But is it typical that they would just hold it? Like, for example, in that fund that you were talking about, like, is it a 10-year hold and you just can expect 2x every few years?
Yeah. Okay. So for that 10-year deal, which is a much different type of deal, that one is they don't see money until the very end. So they're putting in money and waiting 10 years. There's no cash flow out of that at all. With the other deals, when you do these one-off properties, then it's just here 2x in that 2 to 3 years. Here's your money back. Congrats, and move on.
I see. Okay. So it's not as long of a hold, and then you are seeing your returns and
Yeah.
distributions throughout those 2 to 3 years, or no?
Nope. Because there's
Okay.
just nothing to distribute. Now, I have seen some build to rents out there where you can start distributing. Like I said, if you're building 150 units and now you've populated 90 units and you're just finishing off the last, you could start distributing some rents,
I
but
see.
it really comes down to the business plan and the operator from there.
Well, it makes sense that you wouldn't really expect distribution. So to go kind of full cycle on a build to rent, you mentioned that financial institutions buy them up. Who are like what are the financial institutions? Just for my
Mm.
basic understanding, what do you mean by that?
So you got to think, like, I mean, even Blackstock, BlackRock, and Blackstone are big financial institutions that would buy something like this up. JP Morgan, REITs, All of
I
those could be
see.
buying these up. So yeah, just to come full circle and clarity for your listeners, our goal isn't to build and stabilize well, I should say we build, stabilize, and sell. And stabilize meaning we populate it, we build it, we lease, occupy all the units, and then we turn around and sell as quickly as possible. That's how we get the 2x. If you want to sit and stay on it, it is kind of a cash cow. You can likely do a cash out refi, get out of your builder loan, and then sit on it with a long-term fixed, and then just cash flow, and you have a great property that's just cash flowing. But that's why the big institutions want it too, because it's a great asset that's going to be cash flowing.
And are there 1031 exchanges in this equation?
There, there can be, yes. It's
Okay.
entirely dependent on how the operator wants to manage it.
Wow, this is a whole new world that's kind of blowing my mind right now, and it's probably beyond my scope. But we'll kind of bring it back to some. I would like to talk about marketing if we want to pivot a little bit, because there's the marketing to maybe LPs. Even in that example, there's the marketing to your potential renters. And so, is that part of your team? Like, is that somebody you hire to then go find and place these tenants?
Yeah, so that's a property management side. And I don't play too much in that realm. Like I dabble in it a little, but really we rely on the property management teams to put out the marketing to fill and lease up the properties.
Yeah, that makes sense. But then for, I guess, is it marketing? Can you call it that when you're bringing LPs into your fund to fund, or how do
So
you target these folks?
yeah, so from the LP standpoint, yeah. Yes, you have to market, you have to have brand awareness, you have to get your name out there. And as you were saying earlier, it seems like a majority of what you do is education. That's a majority of what I do, and that's a majority of the wrapper around marketing is to educate the world on what we do. To yours, maybe what you're getting at is when I have a property, explicit property that's available as an opportunity to invest in, depending on whether we're 506B or 506C, whether I can take accredited investors or not. If I'm taking accredited investors only, I can advertise. I can say, hey, look, everybody on LinkedIn, Facebook, I've got this great asset. It's going to cash flow awesome. Check it out. If you want to invest, I'm free to put up billboards and commercials as much as I want.
Mhm.
If I'm bringing in sophisticated investors, I have to play it much more carefully. We run under the SEC regulations. If I'm bringing in people that are non-accredited, I have to have a relationship with them. Now, it's a bit gray as far as how the SEC defines what a relationship is, but as an industry, we've tried to put big bookends on it. So new investors typically coming into me, I evaluate where they're at in life, their career, how much they make. Like I have to evaluate, are they, I hate saying this in this form, but are they intelligent enough to make smart decisions with their money?
Right.
I guess I can use the example. If a McDonald's employee calls me and says, hey, I want to invest, I'm going to say, well, for one, you don't make enough money. And two, I don't think you're sophisticated enough to make a decision to invest in a property like this. So I
Right.
really start evaluating people. But largely what I get into is I get these engineering leaders who are making $180,000 a year. They may not be accredited yet, but they're making
Yeah.
enough money. They are proven to invest. They they take interest in how their finances are moving around. It's that sort of stuff. So that way, if something goes wrong and someone wants to sue, the SEC can't go and indict me for bringing a McDonald's employee in.
Right. And that's no shade on McDonald's employees. It's just about having maybe the financial literacy and the financial
Yeah,
stability to be able to take a risk, because this is a risk at the end of the day, and really looking out for them so that we're not being vultures and taking advantage of people. So
yeah.
I think, while it is, you say it with humility, and I agree with it. It's you don't want somebody not sophisticated to come on and sign up for something that's way over their heads. So
And
on that,
that's
oh,
explicitly why the SEC calls it sophisticated investors.
yeah, makes sense. So one way is to use retirement accounts to invest in these alternative assets. Can you explain a little bit about how people can do that?
That's essentially you're shifting your IRA outside of a brokerage account, your Fidelity, to your price, and you're putting it in what's essentially a LLC. A lot of these are custodian controlled, so you have to go to a custodian who can set this stuff up for you, put the paperwork in place. But at that point, your IRA, self-directed IRA, can now be invested into a whole bunch of alternative assets. There are some limitations to that, so be careful as you get in. Another thing to note there is there's a UBIT tax, UBIT. I forget what the acronym means. But when you get into real estate, you're investing in real estate, you can be taxed within your tax shelter. Now, the taxes aren't super prohibitive, but they are there, and I need people to be aware when you go do it to understand it. A lot of people, including myself, love investing our self-directed IRAs into real estate, knowing that there is that tax there because it's not prohibitive. Our returns in real estate are likely going to be so much more that that tax becomes negligible in the overall run. The other aspect, the other way you can do retirement accounts is a solo 401k. The limitations there is you have to be self-employed. You have to have your own LLC. You can create a solo 401k. The benefit there is you can do the same thing as a self-directed IRA, but there's no UBIT tax. So I really like my solo 401k out there working rather than just sitting in random mutual funds and index funds in the stock market.
Yeah. Okay. No UBIT tax on the solo 401k. And just to be clear, because I was trying to explore this myself, I am employed in a W-2, and therefore I cannot use any of my 401k for this type of investing, if I'm understanding correctly.
It depends. You have a 401k from a prior company.
I do. It's not as big because I've been with my company for a long time. And so those were like more minor side, like part-time jobs. And this has been my like full-time career. And so my big funds are like not accessible to me unless I quit, right?
Yeah. I mean, there's a lot of people out there that have moved around enough and they have built up 401ks. And if, like yourself, if you had $50,000 in those older accounts, you technically could do a solo 401k, especially because I think you have your side gig. You probably have an LLC set up.
Yep.
That you could leverage that. But yes, it is limited. Not everyone has their own personal business that they could set one up with.
Right. And did you deploy, because I imagine, you had this long career as an engineer and then you left the job, actually, you said 2023, so early last year. And then did you end up using some of those funds to go into real estate, or did you just kind of start entirely new?
Those were actually my first LP investments. So before I went active as a GP, I established Vestus Capital, and I was starting to work at becoming a GP, but I set up my solo 401k and deployed it into 2 different real estate assets back in 2020. One of them went full cycle last year as well. So it's kind of fun.
Nice. Awesome. Well, I know we're coming up on time. This has been quite the informative session. I might even need to re-listen to make sure that I'm tracking on all the pearls that you put out there for us. We learned about fund to funds, we learned about build to rent, and just so many other opportunities to keep growing your wealth. What advice might you say, just generally for our listeners? What would you give them if they're thinking about either getting into this or just finding other streams of income on top of their W-2?
Yeah, the best advice I give to anyone is just take action. I could be in a much different place right now in my life had I not been a stereotypical engineer and had analysis paralysis and dragged my feet and been naturally skeptical. I mean, some of that's a little healthy, but I think I dragged my feet for several years. And then I finally just decided to take action. You're never going to know everything. That's why we partner with people. And then on top of that, you're not going to be able to learn everything out of a textbook. Sometimes you're just going to have to learn through the school of hard knocks. And it's not always easy, but you just accept it. Just hit the ground running. And it doesn't mean you're going to lose money either. It could just be like, oh, here's a new thing I better learn that you would have never thought.
That is great advice. So take action. You can't know everything. That's why we partner. I really love that. And can you give us, just before we close out, a glimpse into your life now? Because you mentioned that, or at least in your bio, I read that, the burnout is what brought you over to real estate investing. That's frankly what's happening for me. And I'm, living the corporate life, I do love my job. I love my company, but it takes up a ton of hours and, the standard 40-hour work week. Are you doing a 40-hour work week now as, the founder of Vestus Capital, or what does your day and week look like
Yeah,
now?
it totally varies. It is hard to run your own company, and I do work a lot of hours, but then again, have total control over my hours, so I can always take a day off when the kids have a day off. I don't have anyone to report to. I can go on vacation when I want. But in general, it's like you realize you gotta put in that sweat equity in order to make the money. And I haven't scaled to the point where I have fully automated VAs and stuff working behind the scenes. So a lot of it's still on me until I scale to a point where it's more of a machine that runs without me.
Yeah. And that makes me think about, I'm sure you've read E-Myth or
Yes.
Traction, those books
Yes.
that all of us have read. And so, and as an engineer, you must be thinking about processes and how to make this all a complete operation. And I'm curious
Yeah.
to see how that unfolds for you. But
Yeah.
cheering you on all along the way. Really, really grateful to have met you and spent this time together. And for those who want to learn more about you or find you online, where should they look?
Yeah, I think the easiest place is find me on LinkedIn. It's just LinkedIn/Flint Jamison, or you can investwithflint.com. It takes you right to Vestus Capital.
Nice. Investwithflint.com.
Yeah.
That's
So
great.
I just bought that domain because it's easier for people to remember. Oh, invest with Flint, but it'll take you straight to vestuscapital.com.
Fantastic. Investwithflint.com. Vestus Capital. Wonderful. It has been a pleasure, Flint. Thank you so much for your time today.
Thank you, Amanda.
Today's episode was sponsored by Matrix Arch Capital. And you can find me on Instagram at Amanda the Investor. Send me a message. I'd love to hear from you.